We're going to be talking about industry classification of stock exchanges. Let's start off firstly with oil and gas. Oil and gas are companies like Shell, BP, they provide fuel to your cars and stuff. They're very risky. They tend to be independent to the rest of the stock market, and they depend on your dollar denominated oil and gas prices. They involve mainly extraction and supply of oil. They tend to be large global multinationals, very risky, and they depend on commodity prices. You then have basic materials. They're very dependent on economic growth. They tend to supply intermediate goods such as chemicals, paper, metal, and building materials. We then have the industrial sector. The profits tend to go in cycles. They make capital goods such as aircrafts. They will have low gearing because their profits will be volatile. They are exposed to overseas markets and competitions. For example, China. China plays a big role in this sector. And to a varying degree, they depend on government spending. We then have consumer goods. Consumer goods fall into durables and non-durables. Durables are furniture, and those profits tend to go in cycles. Non-durables are, say, beverages and food, tobacco even. The profits don't go in cycles, they're more stable. This sector, the profits tend to have low margins because of such high competitions, and because of the competition, brand names are very important. We then also have consumer services. Now, in this sector, labor is quite intensive and they're very domestically based. Some examples would be hotels, restaurants, media. They are defensive and therefore they can gear quite highly. We then have the healthcare sector, where they provide medical and pharmaceuticals. This sector is also not, the profits don't go in cycles. We then have utilities. This is one of my favorite sectors because it's quite stable. They tend to have natural monopolies. They provide services to the public. Although having said that, they do tend to have high regulations. There's political risks. Government might throw in price controls, and they're quite difficult to start up because they need extensive infrastructure, which makes them capital intensive. You then have the telecommunication sector, which is very similar to a utility, but it's less regulated, and thus it will be more volatile. Vodafone is one of the main telecommunications companies. We then have the financial sector. Now, this is very capital intensive. You've got your banks and your insurance companies. And now, a little question for you guys, which you can answer in the comments below, is when interest rates increase, what is going to happen to the profits of the financial sector? Now you can think of, well, a little bit of hints would be to think of what happens to bad debts and the endowment effect. It's a very difficult question, so don't worry if you can't answer it, but have a go in the comments. And then the final sector is technology. This is your companies that are all into computers and the internet. They provide hardware and software. They tend to have low dividends and lots of intangible assets. Facebook's also one of the new big comers in the technology sector. And that's industry classification. The reasons we do so is for two main reasons. It's practical, and these shares tend to be correlated. It's practical because the factors that influence these companies are very much the same. They get the information from the same source. And what's nice is it gives structured decision making. We want to buy in so many sectors, then we look at the company. That's like a top-down approach. And then the performance of these companies tend to be correlated. They have the same resource and input costs. they're affected by the same market forces, and they have similar financial structures. When the interest rate changes, they tend to move in the same way. But look, this isn't a perfect system. I mean, some companies are in more than one sector, and there tends to be a lot of heterogeneity within sectors. There's different sizes, and some tend to be more of niche players. Having said that, it's a nice way to group stocks in their exchange, and it does help in deciding which one to invest in. Thank you.